What if XRP doesn't need billions to move, just millions? That question sounds like the setup for a price prediction, but it's actually a question about market structure. About how liquidity works, how order books function, how the relationship between capital inflows and price movement varies dramatically across different assets depending on their size, their float, their trading depth, and the behavior of the participants who hold them. The number that surfaced recently was a 490 times multiplier. $17 million in net inflows producing an $8.36 billion increase in market capitalization in a single 24-hour period. If you've never thought seriously about what that ratio means mechanically, it's easy to read it as a reason for excitement. If you have thought seriously about what it means, you understand that it is a double-edged structural characteristic that tells you something important about XRP's current market dynamics, something that has significant implications in both directions, and something that requires a clear analytical framework to evaluate honestly. A market cap multiplier in this context describes the ratio between net capital inflows, meaning the net difference between new buying and selling pressure in dollar terms, and the resulting change in total market capitalization. Market capitalization is simply the price of an asset multiplied by its circulating supply. When $17 million enters an asset with a large circulating supply, and the price moves enough to add $8 billion to the market cap, what you are observing is a mathematical consequence of how thin the effective order book is at the price levels where that buying occurred. To understand why, consider a simplified example. If an asset has 100 billion units in circulation and trades at $1, its market cap is $100 billion. If $17 million of net buying pressure moves the price from $1 to $1.08, the market cap increases by $8 billion, even though only $17 million of actual capital moved the price. The $17 million didn't create $8 billion of value. It moved the price enough on a large circulating supply that the mathematical product of price times supply increased by $8 billion. The multiplier is not magic. It is arithmetic applied to a large supply and a relatively thin order book at the margin. The reason the order book can be thin relative to market cap on an asset the size of XRP comes down to a specific characteristic of how XRP is held and traded. XRP has a circulating supply of approximately 58 billion tokens. A significant portion of that supply is held in long-term wallets by holders who are not actively trading it. Those coins are not in the order book. They are not available for immediate sale at current prices. The coins that are available for immediate sale, sitting in exchange order books ready to be matched against incoming buy orders, represent a much smaller fraction of the total supply. When significant buy pressure arrives and works through the available sell orders in the book, it can move the price considerably before encountering the next layer of supply. On a very large circulating supply, even a modest percentage move in price translates into a very large change in market capitalization. The 490 times multiplier is a snapshot of this dynamic under specific market conditions. It is not a permanent characteristic of XRP's market structure. It is a reflection of how thin available liquidity was relative to incoming demand at a particular moment. And understanding that context is essential for evaluating what the number actually means. The infrastructure connections that Ripple continues to build are relevant to this liquidity discussion because institutional adoption and real transaction volume are what drive durable, sustained increases in market depth rather than the short-term volatility that thin order books produce. Ripple's new integration with I-Payout is worth examining in specific terms. I-Payout is a global fintech company founded in 2007 that specializes in real-time global disbursement infrastructure, facilitating payouts in 180 countries across 140 currencies for gig economy platforms, marketplaces, gaming companies, and financial services clients. The integration with Ripple's payment infrastructure means that I-Payout's disbursement network, which operates at significant scale, can now route certain payment flows through XRP-based corridors for the markets where that is the most efficient routing option. The whiteboard and I-Payout's materials that showed JP Morgan in a diagram generated significant speculation about a direct partnership between Ripple and JP Morgan Chase. The honest interpretation of that material is considerably more modest. The diagram illustrates I-Payout's ability to connect with major correspondent banks, including JP Morgan, as part of its existing banking relationships. It is not a partnership announcement between Ripple and JP Morgan directly, and presenting it as such would be inaccurate. What it does illustrate is that I-Payout operates within the established correspondent banking network, while also integrating blockchain-based payment rails, which is precisely the kind of hybrid infrastructure model that allows blockchain payment systems to reach endpoints that pure crypto networks cannot yet access directly. The Federal Reserve access question is where the institutional infrastructure story gets most consequential and where precision about what is confirmed versus what is in progress matters most. Ripple has been actively pursuing an OCC national bank charter and a Federal Reserve master account, two separate but related approvals that together would give it direct access to the core infrastructure of the U.S. financial system. The OCC conditional approval for Ripple National Trust Bank, expected by the timeline referenced in reporting, would allow Ripple to operate regulated custody and settlement services under a nationally chartered bank framework rather than relying solely on state-level money transmission licenses. A Federal Reserve master account would give Ripple direct access to FedWire, the Federal Reserve's real-time gross settlement system that processed over $1 quadrillion in transfers in 2022, and potentially to FedNow, the Fed's instant payment rail. The significance of direct Federal Reserve access cannot be overstated in the context of institutional adoption. Currently, non-bank financial institutions that want to participate in the U.S. payment system must do so through correspondent banks that have master accounts. Every intermediary adds cost, adds latency, and adds a point of dependency that a direct participant does not have. If Ripple achieves direct Fed access, it changes its competitive position in the U.S. payment infrastructure market from a technology provider that works alongside banks to an institution that operates at the same level of the payment stack as banks. What must be said clearly is that these approvals have not yet been fully granted. The regulatory process for both national bank charters and Federal Reserve master accounts is lengthy, involves multiple agencies, and can be affected by changes in regulatory priorities. The direction is positive based on current reporting, but treating pending approvals as confirmed facts would be misleading. The tokenization vision that Ripple executives have been articulating publicly frames XRP's long-term role in terms that go beyond the current payment corridor business. The argument is that as financial assets become tokenized and move onto blockchain ledgers, those ledgers will need a native settlement and liquidity asset to facilitate the movement of value between different tokenized positions. In the same way that physical settlement of securities historically required a settlement currency, tokenized asset markets will require settlement assets that can move at blockchain speed and cost. XRP's design, with its 3 to 5 second settlement and fractional cent transaction fees, makes it a natural candidate for this role on the XRP ledger. Robert Crossley of Franklin Templeton has articulated the broader principle clearly. Financial assets are becoming software, and when assets are natively on-chain, the traditional distinction between investment capital and operational capital collapses. Capital that is on-chain can simultaneously serve as an investment position and as operational liquidity without the delays and friction costs of moving between different systems. Ripple is investing significant resources into the XRP ledger's ecosystem development based on a thesis that tokenized asset markets will generate substantial demand for settlement infrastructure on select ledgers, and that XRP is positioned to be the settlement layer for the flows that move through XRPL. The ETF inflow data provides a window into how institutional capital is currently engaging with XRP through regulated products. 6 XRP ETF products recorded a combined $20 million in trading volume with Bitwise leading inflows, followed by Franklin Templeton, Canary, Grayscale, Rex, Osprey, and 21 shares. Sustained net inflows into ETF products during periods of broader market weakness are an indicator of the investor type that is participating. When retail momentum traders are in an ETF primarily because prices are rising, they tend to exit when prices fall. When institutional allocators and financial advisors are in an ETF as a structural position, they tend to maintain or increase exposure during price weakness. The fact that XRP ETFs are showing sustained net inflows rather than outflows during periods of market stress suggests that at least some portion of the capital in these products reflects a longer-term allocation thesis rather than short-term momentum. ETF flows also matter for the underlying market structure because ETF providers who receive inflows need to acquire the underlying asset, which adds genuine buying pressure to the spot market rather than simply redistributing existing holdings between traders. As ETF assets under management grow, the regular rebalancing and inflow activity of those products becomes a more significant component of the underlying market's demand structure. The risks embedded in XRP's current market structure deserve as much analytical attention as the opportunities, because the same characteristics that produce a 490 times upside multiplier produce an equivalent downside multiplier under selling pressure. If the order book is thin enough that $17 million of net buying moves the market cap by $8 billion, then $17 million of net selling pressure can move the market cap by a similar magnitude in the opposite direction. Thin liquidity amplifies volatility in both directions without discrimination. This is not a characteristic unique to XRP. It applies to every asset where the effective float available for trading is small relative to total market capitalization. But it is a characteristic that makes short-term price behavior in XRP highly sensitive to relatively small changes in net capital flows, and that sensitivity can work against holders just as dramatically as it can work in their favor. The long-term resolution of this volatility dynamic requires growth in the depth of the order book, which requires growth in the number of active participants willing to provide liquidity at various price levels, which ultimately requires growth in the real utility demand for XRP as a settlement and bridge asset. Organic utility demand from institutions using XRP to settle actual cross-border transactions is the most durable form of demand for any payment-oriented asset, because it is not driven by speculative sentiment, but by the ongoing operational needs of institutions that have integrated XRP into their payment workflows. The convergence of all these threads, the market cap multiplier, the institutional partnerships, the regulatory progress, the ETF inflows, the tokenization build-out, points toward a structural transition that is still in its early stages, but whose direction is becoming clearer. The financial system is gradually becoming programmable. Assets that were historically separate, sitting in siloed accounts, clearing through separate systems, subject to different settlement timelines and custody requirements, are being pulled into a unified on-chain environment where the friction between them is reduced to the time it takes a blockchain transaction to confirm. In that environment, the assets that serve as the connective tissue between different pools of capital, the settlement layers, the bridge assets, the liquidity rails, occupy a structural position whose value is a function of the total value flowing through the system rather than a function of speculative sentiment about any particular price target. Whether XRP occupies that position at the scale its proponents envision depends on adoption decisions that are still being made by institutions, regulators, and technology builders across multiple geographies simultaneously. The outcome is uncertain, and the timeline is longer than most social media discussions acknowledge. The question that actually matters analytically is not how high XRP can go in the next market cycle. It is how sensitive the asset is to changes in the capital flows that move through it in both directions, and what the durable demand picture looks like once the speculative component of current pricing is stripped away.